What was interesting about yesterday's move is that when you look at it, it's really real yields that moved up, treasuries, but also UK gilts and across the board in Europe. And you also saw some steepening of the yield curve. So the market is maybe now putting less weight on the risk of a recession, especially in the US in the second part of the year, and thinking, okay, if maybe the labor market is that resilient, the Fed can not only go higher, but stay there for much longer, and potentially well into 2024.
Well, is this a potential soft landing scenario that we're looking at now, given the strength in this labour market?
That could be a possibility, definitely, when you look at yesterday's movement. And if the ADP number is again confirmed this afternoon, that could be obviously opening the door for this soft landing scenario that the Fed is hoping for. And that potentially why also the long end moved that much, because we know that 10-year Treasury yields have been dampened by this expectation that at one point something will break in the US economy and we'll have a recession, and that could potentially lead the Fed at one point in 2024 to have to cut rates somewhat.
OK, so you say that the market is then, we've seen steepening of the curve, and you talked about how a higher rate is then possible, higher interest rates are possible, and perhaps for longer. But how high, Laureline? Is this still the 2 hikes that the Fed has been talking about, or is this something further?
So when you look at the movement, the fact that the 2-year Treasury yield is now at 5%, which is something we haven't seen since 2007, means that still we're getting back to levels that we think are restrictive. Now, I would put attention also on real yields. And what we saw also yesterday is a confirmation that real yields now on the short-term part of the US yield curve are very restrictive. We're talking between 3 to 4% on the 1 to 2 year. And this is something we haven't seen for decades now. And as such, this is going to dampen economic activity in our view.
So the 2-year currently at 4.98, just below that 5% level. Does it look attractive at that level, Laureline? Do you want to get into the front end at this point?
So at this stage, what we have done rather is be going into US investment grade corporate bonds, short-term ones. And actually, with the rise we've seen on Treasury yields recently, we've even decided to move overweight on US investment grade and think, OK, maybe it's time to actually lengthen a bit the duration there. Because if at one point we have indeed some Fed rate cuts potentially in 2024, you want to have a bit more duration and to lock your coupon a bit longer.